Are you thinking about refinancing but discouraged because the interest rates have gone up and you're thinking maybe you missed the boat? What if there were still some amazing refinancing opportunities and strategies available to you if you know what to look for and how to properly approach the situation? Well, in today's lesson, I'm going to talk to you about refinancing in an increasing rate environment, exactly what you need to know to save the maximum amount of money on your new mortgage. Check it out.
So why can refinancing when interest rates are increasing make sense then for a homeowner?
Interest rate is one component, but we have to look at, does refinancing make sense for your financial plan? What are your investments doing? What's your retirement look like? Where are you at with your real estate, be it one property or multiple?
So then what do you say to someone who has the idea that refinancing to a higher rate is not part of a smart financial plan?
Well, what I would say to that person is knock it off. I'd hit him across the head and say, every situation is different and you can't make a blanket statement and say it's bad, because I'll tell you stories where going to a higher rate actually made people a lot of money or saved them a ton of money. So I think the first concept that someone needs to understand that has that mentality is, what's debt consolidation all about? If mortgage rates are higher, then that means credit card rates are going up. That means auto loan rates, all these other types of debt that have interest attached to them, those rates are going up as well. So it's all relative. And even if your mortgage rate was 5%, which sounds crazy, right? That's a high rate, or even 6%. Why would you refinance? Because if your credit card's at 20, 30+%, doesn't it make sense to take a hit on one side of the portfolio to make it up somewhere else, right? Mm-hmm. So you can take one step back with your mortgage rate, but take two steps forward by getting rid of your other debt. So that's the first concept. The other thing is mortgage acceleration we've talked about. When rates are going up, mortgage acceleration is a huge, huge advantage, which really refers to paying your loan off early. So when your mortgage rate is super low, it's not as attractive to pay it off quicker because it's such a low rate, right? But when the rates are going up, it makes more sense to pay that loan off quicker, right? And get rid of that interest charge.
What are some specific strategies then that homeowners can use to refinance in a higher rate environment, to save more money over time?
Right. So we were just talking about debt consolidation, so that's a big one. But one of the things that I like to do, which is a seldom used, little known strategy, is to use a debt consolidation refinancing loan and combine it with a mortgage acceleration loan. And here's what I mean is, if you're going to do a debt consolidation refinance, the whole reason to do that is to save money. And typically it's going to mainly be saving money on your monthly payment. $500, $1,000, even $2,000 a month is possible with one of these debt consolidation loans. But what happens a lot of the time is, especially those that are financially undisciplined, they'll save all this money and they feel great. But then you go back to them 6 months, a year later and say, well, you saved $1,500 a month. What'd you do with that money? Where'd it go? Did you put it in the stock market, retirement portfolio? Did you buy a property or an asset with it? And they'll say, no, I don't know what happened to the money. It's what I call evaporation, right? It evaporates into their budget. So the way around that is a strategy I teach where you take the money that you were saving on that consolidation refi, again, couple hundred, couple thousand a month, and then we project out and run modeling. What does it look like if you took that $1,000 a month and put it on that new mortgage? Think about that for a second. You're saving $1,000 a month by consolidating your debt. You take that $1,000 and put it on that mortgage principal. In a lot of cases, you can actually take a 30-year mortgage and pay it off in a third of the time or less by using that.
What about HELOC versus a cash out refinance in an economy where, the interest rates are increasing, as you just mentioned?
So I really want to caution everybody to be so careful and just don't do a HELOC right now. HELOCs were cool a year or two or several years ago when the rates were in a downward trend and all that. Now that the economy shifted, now that we're seeing inflation, now that we're seeing increased rates, a HELOC's a ticking time bomb. It is a credit card on your house. So if you thought just having a mortgage was risky, what about having an actual credit card attached to your house and having the payments go up? It does happen. So you will be caught off guard, because everyone is. And the cash out refi is a better idea. Even though, again, you might take a little bit of a hit, it's certainty.
What is your opinion on the direction of the mortgage rates over the next, let's do 24 to 36 months?
I hope to think that we've kind of gotten, at least for now, to a top of rates. I do see that we have the potential, maybe not this year, but I'm thinking next year into 2024, when the country enters a recession, which is definitely coming. We're overdue for one. And historically, when we go into a recession, the Fed has to lower rates. It's my hope that after watching today's lesson, you now see that there can be some great opportunities for refinancing, even in an increased rate environment, and where your rate may be going up from what you're actually paying today. So if you found value in today's lesson, please share this with somebody else that may also find value in it. Comment on the post, share, and like it. And if it's your first time watching us, hit that subscribe button and smash the bell so you get notified on all of our future content. It's a major goal of mine to be putting out tons of new information and videos throughout the coming year. You can also reach out to me. I do offer free consultations. You can reach me by call, text, or private message at 860-413-3938. Hope that helps, and we'll talk to you soon. Take care.